A beginner's guide to investing in stocks. 1. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that's performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. When you start looking at statistics, you got to remember that the professionals are looking at each and every one of those companies with much more rigor than you can probably do as an individual. So it's a very difficult game for the individual to win over time, says Dan Keaty, CFP, Chief Financial Planning Strategist at Taya. If you're analyzing a company, you'll want to look at a company's fundamentals, earnings per share, EPS, or a price-earnings ratio, P/E ratio, for example. But you'll have to do so much more. Analyze the company's management team, evaluate its competitive advantages, and study its financials, including its balance sheet and income statement. Even these items are just the start. 2. Avoid individual stocks if you're a beginner. Everyone has heard someone talk about a big stock win or a great stock bet. What they forget about is that often they're not talking about those particular investments that they also own that did very, very poorly over time, Kitty says. So sometimes people have an unrealistic expectation about the kind of returns that they can make in the stock market. And sometimes they confuse luck with skill. You can get lucky sometimes by picking an individual stock. It's hard to be lucky over time and avoid those big downturns also. Remember to make money consistently in individual stocks. You need to know something that the forward-looking market isn't already pricing into the stock price. Keep in mind that for every seller in the market, there's a buyer for those same shares who's equally sure they will profit. There are tons of smart people doing this for a living, and if you're a novice, the likelihood of you outperforming that is not very good, says Tony Madsen, CFP, founder of New Leaf Financial Guidance in Redwood Falls, Minnesota. 3. Create a diversified portfolio. One of the key advantages of an index fund is that you immediately have a range of stocks in the fund. For example, if you own a broadly diversified fund based on the S&P 500, you'll own stocks in hundreds of companies across many different industries. But you could also buy a narrowly diversified fund focused on one or two industries. Diversification is important because it reduces the risk of any one stock in the portfolio hurting the overall performance very much, and that actually improves your overall returns. In contrast, if you're buying only one individual stock, you really do have all your eggs in one basket. The easiest way to create a broad portfolio is by buying an ETF or a mutual fund. The products have diversification built into them, and you don't have to do any analysis of the companies held in the index fund. It may not be the most exciting, but it's a great way to start, Kitty says. And again, it gets you out of thinking that you're going to be so smart, that you're going to be able to pick the stocks that are going to go up, won't go down, and know when to get in and out of them. 4. Be prepared for a downturn. The hardest issue for most investors is stomaching a loss in their investments, and because the stock market can fluctuate, you'll have losses occur from time to time. You'll have to steel yourself to handle these losses, or you'll be apt to buy high and sell low during a panic. As long as you diversify your portfolio, any single stock that you own shouldn't have too much of an impact on your overall return. If it does, buying individual stocks might not be the right choice for you. Even index funds will fluctuate, so you can't get rid of all of your risk, try how you might. Anytime the market changes, we have this propensity to try to pull back or to second-guess our willingness to be in, says New Leaf's Madsen. That's why it's important to prepare yourself for downturns that could come out of nowhere, as one did in 2020. You need to ride out short-term volatility to get attractive long-term returns. In investing, you need to know that it's possible to lose money since stocks don't have principal guarantees. If you're looking for a guaranteed return, perhaps a high-yield CD might be better. 5. Try a stock market simulator before investing real money. One way to enter the world of investing without taking risks is to use a stock simulator. Using an online trading account with virtual dollars won't put your real money at risk. You'll also be able to determine how you would react if this really were the money that you gained or lost. That can be really helpful because it can help people overcome the belief that they're smarter than the market, that they can always pick the best stocks, always buy and sell in the market at the right time, Kitty says. Asking yourself why you're investing can help determine if investing in stocks is for you. 6. Stay committed to your long-term portfolio. Katie says investing should be a long-term activity. He also says you should divorce yourself from the daily news cycle. By skipping a daily financial news, you'll be able to develop patience, which you'll need if you want to stay in the investing game for the long term. It's also useful to look at your portfolio infrequently so that you don't become too unnerved or too elated. These are great tips for beginners who have yet to manage their emotions when investing. Some of the news cycles, at times it becomes 100% negative, and it can become overwhelming for people, Kitty says. One strategy for beginners is to set up a calendar and predetermine when you'll be evaluating your portfolio. Sticking to this guideline will prevent you from selling out of stock during some volatility, or not getting the full benefit of a well-performing investment, Kitty says. 7. Start now. Choosing the perfect opportunity to jump in and invest in the stock market typically doesn't work well. Nobody knows with 100% certainty the best time to get in, and investing is meant to be a long-term activity. There is no perfect time to start. One of the core points with investing is not just to think about it, but to get started, Kitty says. And start now, because if you invest now and often over time, that compounding is the thing that can really drive your results. If you want to invest, it's very important to actually get started and have an ongoing savings program so that we can reach our goals over time. 8. Avoid short-term trading. Understanding whether you're investing for the long-term future or the short term can also help determine your strategy and whether you should be investing at all. Sometimes short-term investors can have unrealistic expectations about growing their money, and research shows that most short-term investors, such as day traders, lose money. You're competing against high-powered investors and well-programmed computers that may better understand the market. New investors need to be aware that buying and selling stocks frequently can get expensive. It can create taxes and other fees, even if a broker's headline trading commission is zero. If you're investing for the short term, you risk not having your money when you need it. 9. Keep investing over time. It can be easy to dump your money into the market and think you're done. But those who build real wealth do so over time by adding money to their investments. That means having a strong saving discipline, holding back some of your paychecks so that you can put it to work in the stock market. You'll be able to put more money to work and grow your wealth even faster. You may already be doing this if you have a 401 retirement account, which takes money from your biweekly pay and puts it into the investments you've selected. Even if you don't have a 401, many brokerage accounts allow you to set up automatic transfers to your account. Then you may be able to set up automatic investments at a broker or one of the best robo-advisors. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.